This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to share with you a new stock that I recently bought on the ASX. This stock is Scentre Group, an Australian real estate investment trust. In today's video I wanted to share with you what the company does, some of the headwinds the company is facing, as well as talk about the management team and its valuation at current prices. I'll also share with you my current portfolio allocation towards Scentre Group later on in the video. So if you enjoyed today's video, be sure to hit like and subscribe. And remember, none of this is financial advice. This is not a recommendation for you to buy, hold, or sell Scentre Group. So with that out of the way, let's get right into the video. Scentre Group operates and has interests in Australia and New Zealand's largest Westfield Living Centre portfolio. The portfolio consists of 42 centres valued at $50 billion. And of that $50 billion, $15.8 billion are owned by joint venture partners, and the shareholders of Scentre Group owns $34.1 billion worth of assets. Now, their centres are spread across Australia and New Zealand. There's 5 centres in New Zealand, and the remaining centres are based in Australia, with the bulk of it in Sydney, having 15 centres. And as you can see over here, more than 80% of population in Australia lives within a 30-minute drive of a Westfield Living Centre. So this does show that centres are in very prime locations. Now, if we look at what's happened to Australia recently, they have been hit pretty hard by the Delta variant, especially in New South Wales, recording 344 new local cases, and this is its all-time highs. Victoria as well got hit pretty hard. Lockdown was recently extended, announced today on Wednesday. As you can see over here, the portfolio by asset value, a large majority are based in New South Wales, and we also have a large chunk in Victoria. So it's not really a surprise to see Scentre Group's share price down quite substantially from its previous 52-week high of $3.13. Over the past 2 months, its share price is down 40 cents and went as low as $2.47 before rebounding to $2.61 per share. And it is precisely because of this dip over here that made me attracted to Scentre Group and its current valuation. Another headwind for the company as well is the rise of online spending. Now, Rona has only accelerated the shift towards e-commerce, and we saw that in the most recent report of Australian Post online shopping report. Over here, we can see online goods spend is up 57% year on year, and online purchasing makes up roughly 16.3% of retail spend in 2020. So this is a shift of the e-commerce space into a more mainstream form of shopping, and this does have implications for shopping mall operators. As well as that, you've seen Amazon coming into Australia, launching in 2017, officially came online in December 2017. And I know this article was 2 years old, but it does show that Australia is gaining momentum since launching in Australia. Now, Scentre is trying to minimize the impact of online shopping and e-commerce by focusing on more services type of activities. So for example, in Westfield Newmarket, which is the one that I go to, they have an arcade over here called Archie's Brothers, so people can go in, play bowling, play the arcades, have drinks at the bar. There's also an event cinema. There's a City Fitness, which gets absolutely packed, super busy, and they also have rooftop dining as well. So these are some of the services that they've tailored the mall into to focus on services rather than retail shopping, so that, you know, people do come in and hang out with friends and family and reconnect with communities, because we all know that during the Rona, people were all so isolated. And at the end of the day, human beings are creatures where we like to mingle around. So that is the reason why they call it living centers rather than shopping centers. And we've also seen the gross cash rent collection rebounding since COVID. So as you can see, last year, the April gross cash collection went down quite dramatically to 59 million. So that is obviously due to the lockdowns. And we've seen that post-lockdown, the first quarter this year, we can see that the revenue collection has returned back to 200 million, which is where it was pre-COVID. So this does show that pent-up demand is real, and that when the lockdown restrictions ease, consumer spending is very quick, and there will be a very swift rebound in people's spending. Now let's talk about inflation a bit, because inflation is a very hot topic in the stock market right now. I think Scentre Group is well positioned in times of inflation. If you look at their leasing contracts with anchor retailers, generally they have long lease terms of 15 to 25 years that are linked to the CPI or the Consumer Price Index. So as long as inflation goes up or down, the revenue that they collect goes up and down with the CPI. As well as that, we see other retailers, specialty store retailers, having CPI plus 2 to 3%. So this is even better, because whenever there's high inflation, they'll be able to increase their prices as well. So in terms of inflation, I think Scentre is very well positioned to continue to make decent profits going forward. Now, let's take a look at the company's debt. Now, debt is always important to look at for a company like a real estate investment trust, because they tend to have quite a substantial amount of debt. Now, you can see the total debt facilities is roughly $16.2 billion. And in the next 2 years, they will need to pay down roughly $2 billion of debt. So if you look at their current short-term deposits and cash, they have $2.6 billion. So that does mean that they'll be able to pay off the next 2 years worth of debt with no problems whatsoever. So I don't think liquidity is an issue for Scentre Group, and Scentre Group was actually one of the few companies that did not raise capital during the Rona. So this company did not experience any dilution in its shares outstanding, as well as having enough cash to pay off the short-term debts. So from a debt perspective, this company is fine. Now, if we look at the management team, I want to focus on one person in particular. That is Peter Allen, the CEO. He has a lot of experience in Scentre Group. So he was working as the CFO of Westfield before Scentre Group was formed in 2014. So Peter joined Westfield in 1996, and between 1998 and 2004 was the Westfield's CEO of UK and Europe. So he has 25 years of experience, which is a lot of experience, and he also has a large number of shares, 6.07 million shares, and that number has increased by 500,000 compared to last year's. So now let's take a look at some of the key numbers involved with this company. If you look at FY16 to FY19, the important key measures are up every year. So looking at FFO, funds from operations, so that number has increased every year from 2016 to 2019. If you look at the distributions or the dividends that the company pays out, that number has also increased every year for the past 4 years, excluding 2020, of course, and the assets under management as well. So FY20 was an unusual year, and you can excuse the company for that, but that does show that management has been executing really well prior to 2020. So I'm not too worried about the short term. I'm more focused on the long-term picture over here. And if we look forward into the next year, the group expects to distribute at least 14 cents per share for 2021, and the company recently did declare a 7-cent distribution going ex-date on the 13th of August. So that will be in the next few days, so you might see the share price drop by 7 cents, and that is because of the shares going ex-dividend. Now let's take a look at the margin of safety. Today's share price is $2.61 as of recording on 11th of August, Wednesday. Net tangible assets per share is $3.63. Last year it was $4.46. So that's a huge decrease, and that number is based on what the independent valuer says. So if things go back to normal, you can expect to see the net tangible assets per share go back up closer towards $4. Currently at 14 cents per share of dividend, that represents a yield of 5.3%. A return to normal of roughly 22 cents per share would mean the shares are currently trading at 8.4%. Now, I'm not saying the company will go back to normal anytime soon. In my intrinsic value calculation, $3.15 is based on the company returning back to normal by 2025, okay? So I'm being very conservative, saying that the business won't recover until 2025, and even then the share price today is undervalued, represents an upside of roughly 20%. And if you disregard that, what Goldman Sachs says is that if you destroy all the buildings, repurpose it, land value itself is worth around $2.30 per share. So that is the thick margin of safety, in my opinion, The land value is worth $2.30. The net tangible assets is worth $3.63, and that is already discounted from $4.46. As well as that, on the AFR, there was an article on the weekend showing that Scentre Group is a potential M&A target. If they do get acquired, expect a 30% premium, and even then, I think the shares are still cheap. So over here I have the peer comparables of Scentre Group, and the most comparable one is stock ticker VCX, Vicinity, which is also listed on the ASX. They trade at 0.72 times book value. Scentre trades slightly below that, so practically the same valuation in terms of book value, but I like Scentre Group's portfolio a lot more than I like Vicinity. Scentre Group's portfolio is more premium and better locations compared to Vicinity. If we look at the price to FFO of each of the shares, so Scentre Group, Simon Property based in the US, and Vicinity, they're all trading roughly similar, but I prefer to go with Scentre Group because Scentre Group has a better property portfolio. Now, looking forward into the month, they do announce their half-year results on the 24th of August. So that will show us what the impact of the recent Rona lockdowns in New South Wales and in Victoria and in Queensland will have on the company. That is very important to note. So I'll be keeping an eye out on those results. So I've initiated a 10% position in Scentre Group in my portfolio. I'm willing to increase this up to 20%, just looking for a better price because I already accumulated 10% in about the $2.55 range. So I'm very happy with my cost basis, and I'm looking to add more on weakness in the share price. There's going to be more downside risk if lockdowns extend, but with Australia's population getting vaccinated, I've seen some estimates saying at 80% by the end of the year. I think the lockdowns are a short-term event. I don't think it's going to have a huge impact on Scentre Group's long-term business. I think people will still gather around shopping malls in prime location to mingle with friends, with family, and I think there's a lot to like about Scentre Group's portfolio. So let me know what you think about Scentre Group. If you enjoyed today's video, be sure to hit like and subscribe. Thank you guys for watching. Until next time, take care.